Welcome to our latest deep dive into the source material. We have a truly custom tailored journey prepared for you today, focusing on the really fascinating corporate evolution of Victory Marine Holdings Corp.
Trading under the ticker VMHG.
Right,
Right.
exactly. VMHG. And today's stack of sources is it's just an absolute treasure trove for anyone who loves corporate mysteries and financial engineering. We are looking at a series of deep financial disclosures.
Specifically, I believe we have an annual 10K from 2024 and those three quarterly reports from 2025.
Yeah, that's right. And to cap that off, we have a very telling OTC change in control supplemental document from February 2026, plus a fresh press release from that exact same month, and a website snippet from a highly intriguing beverage brand called Gucci.
It is quite the stack of reading. And it tells a story that, you really only see in the public markets. It perfectly highlights the sheer mechanics of a complete corporate metamorphosis.
It really does. So the mission for this deep dive is to connect the dots between a Florida luxury yacht brokerage's balance sheet and a strategic corporate takeover by consumer beverage executives.
Which sounds completely wild on the surface.
It does. It sounds like two completely different worlds colliding, but when you look closely at the filings and really understand the structure of public holding companies, the breadcrumbs are all there. Okay, let's unpack this by starting with what Victory Marine Holdings Corp actually was up until very recently.
I think that is the best place to anchor our understanding. Because if you were evaluating this company through, say, late 2025, you would see a licensed and bonded yacht broker based right down in Miami, Florida.
Yeah.
The company was led by its CEO, Orlando Hernandez, who was a man with over 25 years of serious hands-on experience in the boating industry.
Right, and the filings emphasize his deep background. Victory Marine itself had established partnerships with some incredibly high-end world-class manufacturers. I mean, they were working with Johnson Yachts, Mazu Yachts, Sunreef Luxury Catamarans, and a yacht tender manufacturer called Argos Nautic. So, on the surface, it's a very glamorous Miami business.
It certainly sounds glamorous. I mean, selling luxury catamarans paints a beautiful picture for investors.
Oh, absolutely.
But, as anyone who follows the markets knows, the financial realities of a public holding company often paint a much more complex, grounded picture than the glossy brochures of the luxury assets they move.
And that becomes incredibly apparent the second we dig into the 2024 and 2025 financial reports. Let's look at the actual numbers on the cap table.
Let's do it.
Across these filings, the company maintains a steady 110,360,680 common shares outstanding.
Right.
But the balance sheet shows a company carrying some significant historical weight. At the end of 2024, Victory Marine reported an accumulated deficit of roughly $5.8 million.
And that kept growing.
Yeah, by September 30th, 2025, that deficit had grown to over $6.1 million.
And a sizable portion of that financial picture involves accrued officer compensation, which is very important to note.
Yes, the filings outline a 5-year employment agreement with Mr. Hernandez for $25,000 a month, plus commissions and performance incentives. But because the cash wasn't necessarily flowing out of the business to pay that salary in real time.
It's simply accrued on the books as a liability.
Exactly. By the third quarter of 2025, that accrued officer compensation had climbed to a massive $1.62 million. But what really stands out when you read these disclosures, and what I really want to push on here, is the debt structure, specifically these convertible notes.
This is a crucial part of the architecture of this company, and honestly, it dictates everything that happens next.
Well, the sources outline a few of these specific notes. There is a $250,000 convertible line of credit with Green Tree Financial Group, specifically naming R. Chris Cotton, and another $35,000 note with a consultant named Tice Lee Proenza. Now, I have to play devil's advocate here for a second, because the conversion terms on these notes feature steep discounts to the market price.
They do.
Often 50% of the lowest trading price over a 20-day period. Now, if I'm an investor looking at a fraction of a penny conversion rate, my alarm bells are ringing. When debt constantly converts into millions of new shares at massive discounts, it creates a dilution spiral that typically destroys common shareholder value. How is that not just a massive red flag?
I want to stop you right there, because it is a very common reaction to view those terms and assume the worst.
Sure.
However, I explicitly instruct you, and everyone listening, not to view these convertible notes as toxic debt sinking the company. What's fascinating here is that this convertible debt was actually a standard, highly strategic capital raising tool playing a very specific role.
Okay, I hear you, but I look at a $6.1 million deficit and steep conversion discounts, and strategic isn't exactly the first word that comes to mind. Walk me through the mechanics of why this wasn't just dragging the equity down.
You have to look at the utility of the capital. While the financial filings do contain standard boilerplate language about a going concern, this specific debt structure provided essential leverage.
Leverage for what, exactly?
It generated the immediate working capital required to keep the public entity active. In the OTC markets, staying compliant meaning paying your auditors, filing your 10Ks and 10Qs on time, paying your legal fees, it costs a significant amount of money.
That's true. The reporting costs alone are brutal.
Precisely.
Yeah.
Without that strategic bridge capital from those convertible notes, the holding company would have lost its compliance status and likely gone completely dormant.
Ah, I see.
Instead, it was kept alive, current, and positioned perfectly on the runway. It acted as a stepping stone rather than an anchor.
So that requires looking at the ticker symbol not just as a reflection of a yacht business, but as a financial vehicle in its own right. It wasn't dragging them down, it was keeping the vehicle fueled up and parked, waiting for a new pilot.
That is exactly the right way to frame it.
Which brings us to the massive plot twists in the story and the sort of shopping process that likely preceded it. I'm looking at this OTC supplemental disclosure dated February 19th, 2026. This document reveals that a seismic shift happened behind the scenes on January 29, 2026.
Yes, this is the official change in control event, and it perfectly illustrates why a compliant public shell is so incredibly valuable.
On that January day, Orlando Hernandez, the yacht veteran, sold his 20 million common shares. But much more importantly, and this is really the fulcrum of the entire deal, he sold his controlling block of 60,000 convertible Series A preferred stock.
That preferred stock is the master key to this entire narrative.
The buyer of this stock was an entity called Red Gemini LLC, which is controlled by a man named William Shane Dunn. As a result of this private stock purchase agreement, Mr. Hernandez resigned from his roles, and Mr. Dunn was appointed as the CEO and sole director.
For anyone studying public markets, this is a beautiful, clean illustration of the mechanics of a public shell acquisition, which is often part of a broader reverse merger strategy. You see, common shares are just one part of the voting power, and usually the messiest part.
Oh, definitely.
But when you look at the rights of those 60,000 Series A preferred shares in the disclosures, they carry a 1,000 to 1 voting ratio.
Let's actually do the math on that for a second. 60,000 preferred shares multiplied by 1,000 equals 60 million votes. Set that against the roughly 110 million common shares outstanding. It's an insurmountable voting block.
Precisely. Possessing those 60,000 preferred shares essentially grants you immediate absolute control over all corporate decisions. By transferring that specific block of stock for cash in a private agreement, the voting power entirely shifts.
Without needing a shareholder vote.
Exactly. You completely alter the trajectory of the public holding company without having to go through the lengthy, complex process of fighting common shareholders or even immediately changing the ticker symbol. Victory Marine Holdings Corp. woke up on January 30th completely under the control of a new management team.
It's a textbook shell acquisition maneuver, but using that specific 1,000 to 1 preferred share block to bypass common shareholder friction is just incredibly clean. It's like someone buying the deed to a house, legally changing the locks overnight, and starting a full interior renovation, even if the old family's name is still painted on the mailbox outside.
That is a perfect analogy.
And we find out exactly what the new owner plans to do with this house in the press release that dropped shortly after on February 24th, 2026.
Right. This is where the strategic vision finally moves from private maneuvering to public knowledge.
The restructuring really takes shape in this announcement. William S. Dunn transitions to chairman of the board, and a new player enters the arena. Robert J. Gruss is appointed as the new chief executive officer, effective immediately. Here's where it gets really interesting.
Tell us about Mr. Gruss.
Robert J. Gruss is not a maritime expert. He's not bringing in a new line of luxury catamarans to turn the yacht brokerage around. He is a high-level consumer brand and beverage scaling expert.
It is a profound pivot. It completely recontextualizes the past 2 years of financial filings we just discussed.
Let's bring in our final source to understand who Mr. Gruss really is and what he represents. We have a snippet from the website of a brand called Gutsy. Gutsy is a beverage brand powered by the Grew Distribution Group, which is linked to Dunn & Grew Beverage Holdings.
So we see the connection right there.
The website details an incredibly on-trend product line. They have clean, still water that is mineral-powered and uncompromised, zero sugar, sparkling water with real function, and a prebiotic mineral soda that reimagines classic flavors with prebiotic fiber and balanced sweetness.
We really need to contextualize that product line. Prebiotic sodas and functional beverages are currently one of the most explosive growth categories in the entire consumer packaged goods space.
It's everywhere right now.
It really is. Consumers are aggressively moving away from legacy, high-sugar sodas and demanding functional health benefits, like gut health, without sacrificing taste. It is a highly lucrative but highly competitive sector.
And the gutsy source material makes a point of highlighting Gru's operational muscle to compete in that sector. They state they have decades of real-world beverage experience, from manufacturing and logistics to retail execution and national distribution. They specifically claim that Gutsy isn't just formulated well, it's built to scale responsibly, reach shelves efficiently, and deliver consistent quality.
And scaling a national beverage brand requires an immense amount of capital for bottling runs, slotting fees at grocery chains, and massive marketing budgets.
Which brings us to the core thesis of this entire transaction. When you look at the Yacht financials and then look at the capital requirements of these prebiotic soda executives, the strategy becomes glaringly obvious. Why would beverage gurus take over a marine holding company? The press release gives us the exact vocabulary. It mentions Mr. Gru's capital markets focus and the company's commitment to evaluating strategic transactions.
They didn't want the yachts.
No, they wanted the ticker.
That is the essence of a reverse merger strategy. Taking a company published from scratch through a traditional initial public offering, or IPO, is an incredibly prohibitive process right now. It takes millions of dollars in underwriting fees, legal counsel, and roadshows, and it can take anywhere from 12 to 18 months of intense regulatory scrutiny.
Nobody wants to wait that long.
Exactly. However, if you find a fully reporting, compliant public entity like Victory Marine, you can acquire control through a private stock purchase.
Bypassing the traditional IPO line entirely.
You then have a fully functional public vehicle ready to inject your new high-growth consumer brand into. Once the merger is complete, the beverage company can use the public stock as a currency for acquisitions, or raise capital from institutional investors much faster than a private company ever could. It is a calculated, aggressive move aimed squarely at rapid enterprise value creation.
That makes perfect sense from a structural standpoint, but I want to circle back to the balance sheet because this raises an obvious question for any investor watching this transition. What about all that legacy yacht debt we discussed? The $1.6 million in accrued salary, those convertible notes with Greentree and Parenza.
Right.
How does a new beverage CEO actually handle the historical baggage of a marine business? Because you can't just ignore SEC-filed liabilities.
If we connect this to the bigger picture, the outlook for that balance sheet is actually extremely positive.
Really? Tell me why.
We can safely assume this convertible debt will be strategically paid off, restructured, or expertly managed by Mr. Gru and his team.
Let's break down the how of that. Turnaround experts don't usually just drain their new company's cash reserves to pay off old management's accrued salary at full retail value. What does disciplined restructuring actually look like in practice here?
Look at the exact phrasing used in the February press release regarding Mr. Gru. It highlights his specific expertise in disciplined restructuring, scaling consumer-driven brands, and prudent capital allocation. In the real world of corporate finance, a CEO with this kind of capital market savvy uses a variety of mechanics to clean up the cap table.
Give me an example.
Well, for instance, instead of letting those convertible notes convert at a floating 50% discount, which causes that death spiral dilution we talked about earlier, he might negotiate a fixed-rate conversion.
So he goes to the debt holders and says, "We're a high-growth beverage company now. Let's lock in a set price for your equity so we all win."
Exactly. Or the new management team might use an initial tranche of fresh bridge financing to simply buy out those old notes at a negotiated discount. Debt holders in dormant shells are often willing to take a haircut on the principal just to guarantee a cash exit.
That makes total sense.
Alternatively, they might issue a new, cleaner class of preferred equity to settle the accrued officer compensation. This isn't a team that just hopes for the best. They are sophisticated operators. They understand structured transactions, and they will utilize that expertise to resolve the legacy liabilities to the direct benefit of the new enterprise.
So the debt truly was just a temporary phase, a bridge that served its purpose and will now be cleanly dismantled by the new architects.
It kept the public entity alive and compliant, allowing this new, highly lucrative consumer product vision to find a publicly traded home. The beverage executives are not going to let legacy marine debt hinder a national rollout of zero-sugar prebiotic soda. They bought the shelf for its utility, and they know exactly how to polish it.
So, what does this all mean? When we look at this entire stack of sources, tracing the breadcrumbs from the 2024 annual report all the way through to the 2026 press releases and the gutsy product catalog, what is the ultimate takeaway for you, the listener?
The core takeaway is that this is a real-time masterclass in how to read between the lines of dense financial disclosures. You have to look past the surface narrative.
Because to the untrained eye, looking at the 10K and the quarterly reports, this just looked like a struggling Miami yacht broker accumulating a $6 million deficit and buried in convertible notes.
Right.
But in reality, it was a perfectly primed public vehicle, kept compliant through strategic leverage, just waiting on the runway for a visionary consumer brand executive to take the helm and redirect its flight path into a booming consumer goods sector.
It completely shifts how you read an SEC filing or an OTC disclosure.
Yeah.
What stands out to you? Think about how rapidly a company's entire fundamental nature can pivot in the public markets.
It's staggering when you see it happen in real time.
Through a single private stock purchase agreement, transferring 60,000 preferred shares, an enterprise goes from selling offshore center console boats to preparing for national distribution of functional sparkling water.
It's corporate whiplash in the best possible way. The speed and efficiency of the reverse merger strategy are just incredible to see mapped out in the actual paperwork.
And it leaves us with an incredibly compelling thought to mull over as we close out today.
Let's hear it.
If a Miami luxury yacht holding company can seamlessly transform almost overnight into a potential public distribution vehicle for zero-sugar prebiotic soda, what other seemingly stagnant public companies hiding in the market right now are just one private transaction, one clean cap table, and one visionary CEO away from becoming the next massive consumer conglomerate?
The public markets are full of dormant vehicles, just waiting for the right driver with the right map. The next big thing could literally be hiding inside yesterday's forgotten ticker symbol. That wraps up today's deep dive into the source material. We hope you enjoyed unpacking this corporate mystery as much as we did. Keep reading between the lines, and we'll see you on the next one.